Oh, that's pretty tasty. Hey everybody, and welcome back to Age Invests. So Coca Cola, a well-loved company in much of the investment community. Buffett absolutely loves it, he's owned it for decades, and it's currently the third largest holding in Berkshire Hathaway's portfolio. He said he's never going to sell Coca Cola. So is Coca Cola the real deal? Is this a good time to pick up the shares amongst all of the pandemic uncertainty? Let's go through Coca Cola together, analyze it, and find out. We all know that Coke is a great drink. It has been around and keeping us refreshed since 1886, and if you go into the business description of that annual report, one of the first things you'll see is they estimate to sell 1.9 billion drinks every day to the world's population. I just think that is absolutely crazy as a statistic. So, as I said, Coke is a very successful brand, but there's also a lot of other brands that Coke own. These include Fanta, Schweppes, Oasis, and also Sprite. So those are just to name a few. They have great geographical exposure as well. They sell these drinks all over the world in pretty much every country. One thing a lot of people don't know about Coke is they actually outsource a lot of the production process. So the packaging and distribution of bottles, they've outsourced that to another company. So Coke is predominantly focused on just producing and selling the syrup. What this means is that it's not a very capital intensive business at all. And it means that Coke can have very, very high margins. Also, the soft drink space is a little bit of a duopoly. Coke and Pepsi control about 70% of the market share in the soft drink space. So it's a little bit of a duopoly, and Coke dominate most of the market sales in most geographical areas. One thing that would have been really interesting to find out is Coke's breakdown of revenue. I couldn't actually find it, but I really wanted to know what section was wholesale and what section was from the leisure industry, right? Because obviously the leisure sector has taken a massive hit from COVID, and a massive part of Coke's business is selling their products in pubs and hotels, etc., etc. So that's obviously taken a hit. I also think the wholesale part of it would have taken a hit as well, just because Coke, you obviously buy it a lot more when you're having people around for family barbecues and dinners if you've got children around. So I think both parts of the business would have suffered. However, I do think this is a temporary headwind, and with COVID vaccinations around the world being rolled out, hopefully we'll see the lifting of the restrictions and Coke sales go back up to normal in the near future. One final thing to note is that Coke recently made an acquisition to buy Costa Coffee in the UK in 2019. It's a very popular coffee chain where I'm from. Unfortunately, pretty bad timing because Costa Coffee has been adversely impacted by COVID as well, but I thought it was an interesting add-on and could provide a lot of upside in the future. I think that Coca-Cola have a pretty wide economic moat. Firstly, if you look at the brand, it's been one of the most successful brands in history, which keep consumers coming back for more and more drinks. They also benefit from scale advantages on both sides of the business. So on one side, the fact that they're so huge means that when they order commodities like syrup in bulk, they can get a lower per unit cost, which brings their cost down. And then on the other side, because they make so much revenue, they can have much bigger ad budgets, which then they can use for all of their creative advertising campaigns. And then they can reinforce their brand, which has done so well for them in the past. If you're enjoying the video so far, please give it a like. It's really helping my channel grow. Okay, so what are the risks? COVID. It's obviously been a headwind for Coca-Cola. Do I think this is going to be temporary? Yes, I think Coca-Cola are going to bounce back once restrictions are eased. Another risk to consider is the erosion of the brand. Yes, Coca-Cola has a very strong brand and it is amazing, but there comes a flip side to that. If you're so reliant on the brand, then if you do something to damage the brand, that could really hurt your business. And remember, in the soft drinks business, there's very, very low switching costs. So if Coca-Cola do something that harms their brand in the public eye, then it's very, very easy for us all to go, boom, let's go for a Pepsi instead. One example of this could be recently Coca-Cola, there was a whistleblower that came out from Coca-Cola that said it was training its employees to be less white, and they were making race an issue where they didn't need to make race an issue. It was very discriminatory. And that would be the kind of thing where if a lot of people got angry by it, it could damage Coca-Cola's brand, and we could see a considerable drop in Coca-Cola sales in the future. Something else to consider is ESG. Obviously, Coca-Cola, or a lot of Coca-Cola brands, contain a lot of sugar, which is a risk because sugar is damaging to health. The flip side of this is that Coca-Cola has diversified quite a lot by its products such as Diet Coke and Coke Zero. And the final thing to consider is just there's a lot of positive bias in Coca-Cola, right? I feel like because it's such a well-loved brand, a well-loved name, and particularly because Warren Buffett has been so vocal about owning it for so long, I always feel like we're always going to experience some bias to look at Coca-Cola through a positive lens. And if you think about your job as an investment analyst, it's very, very hard for you to go against the herd and issue a bearish rating on somebody like Coca-Cola, just because there's a lot of pressure, because everybody else loves the stock and loves the brand, and it has that connotation with the legendary investor, Warren Buffett. Okay, so let's go through these financial statements. So first thing you can see, turning to the income statement, turnover is down over 10 years. It's not just like Coca-Cola have had a bad year. Turnover is really, really down on a negative trajectory. It's fallen pretty much every year. And then 2019, it went up a little bit, and then we're back down for 2020. And that is not a good sign. I never like to see turnover go down because it's the lifeblood of the business, really. I mean, you know, if turnover isn't going up in the long run, you have to do something untoward. You have to keep raising margins, or you have to keep cutting capex, and it's not really something you expect to see from Coca-Cola. So that's one negative thing. Although I would say that obviously, despite the COVID pandemic and the negative trajectory, to still get 33 billion from 37 billion last year is okay. And analysts are forecasting some growth. But as I said, I think the analysts are often biased towards companies like Coca-Cola. So that's something to consider. The operating margins have clearly been going up quite a lot because operating profit is flat, I would say, maybe growing slightly. It kind of bottomed out about 2016, 2017, and we've gone up a little bit, but it's pretty flat. And I think this situation is pretty similar with net profit. Yeah, so on the whole, not great growth from Coca-Cola at all. If we turn to the balance sheet, I think this looks a lot better. So if you look at current assets, 19 billion, current liabilities, 14 billion. So that all looks good. If you look at the debt, something interesting to note is they've paid down pretty much all their short-term borrowing this year, but then they've taken on a lot more long-term borrowing. So, you know, that's obviously something to consider, is a lot of their debt is not due soon, but that might hurt them a little bit more further down the line, although it's not really a concern because their liabilities compared to their assets, their liabilities are pretty low. So that's always good to see. What's their cash position, cash and cash equivalents? So they've got quite a lot of cash, 7 billion in cash. It's important to note, though, they were hit with a massive 3.2 billion lawsuit. It was basically not a lawsuit, extra tax they had to pay. That's what it was. And yeah, obviously they're going to have to use some of the cash for that if that goes through. I know they're trying to fight it at the moment. Coming to the cash flow statement, again, this looks okay. Net cash from operations, you know, we saw a little bit of a turnaround in 2016, 2017, but really not much growth. Free cash flow, let's have a look. It's going to be a similar story. Yeah, so free cash flow, pretty stable on the whole. One thing to note, though, is that like they pay out a lot of their cash in dividends, right? So you've got 8.6 billion in free cash flow. 7 billion of that is going straight to dividends, which, I don't know, I think for a company like Coca-Cola who really want to keep innovating and spending on growing their business and taking on acquisitions, I think this is too high to be paying all of this out in dividends. And then it does make you think Coca-Cola's position as a dividend king, is it going to be in jeopardy? Because they're going to be in significant pressure to keep increasing their cash flow if they increase their dividends. But at the moment, I'm not really seeing it. I'm just saying this dividend keep being paid out, but this free cash flow not really growing so much. So that is something to consider, is that their dividend payout ratios for earnings and free cash flow is going to be very, very high, and that could damage its position as a dividend king. Okay, so if we're going to talk about dividends, I might as well take you guys over here. So here we have some dividend analysis of Coca-Cola. Dividend has been growing for 58 years. That's why we call Coca-Cola a dividend king. Okay, so here's the free cash flow dividend cover. This is what I mentioned, is that it's pretty low on the whole. I mean, it's been consistently low, so I don't think that they're going to be in any rush to cut it, but then that doesn't really go hand in hand with being a company who, you know, is spending a lot on innovation and kind of keeping its business fresh and new. So that's what I worry about. I don't think that the safety is there. And the yield is good. Like the yield is 3.2%. It's probably not enough to get income investors incredibly interested, but it's a good yield nonetheless, for sure. I just worry that over the years, we've seen this trend where Coca-Cola has been forced to grow their dividend, well, not forced to, but they've grown their dividends because of that, I guess pressure of being a quality dividend aristocrat company. But then at the same time, we haven't really seen free cash flow or earnings grow. So this is why you see back in 2012, 9 years ago, you had dividend cover 1.7, 1.6, and it's kind of been falling. They're over the worst of it, where their free cash flow wasn't covered by the dividend. So that would mean that either have to burn through cash or take on debt to increase their dividend. But it's good to see that it's at least one, although I'm not completely comfortable with this dividend position. Okay, so let's also take a look at Coca-Cola's chart. First thing you can see is obviously they've done very, very well in the long run. Coming out from the 2008 recession, they're worth about $19. Now they're trading at $51.42 a share. So you can see there's been pretty consistent growth in the share price. There was quite a bit of stagnation here. If you remember from the financials, this was kind of where everything was going down. Not only their turnover was going down a lot, but their profits, free cash flow. But it seems to have been on a real bull run right before COVID hit. And then it was peaked about 59. And now it went all the way to 37 and it's kind of been trading in this upwards trajectory ever since. So the first thing I would say is that it's good to see it below its pre-COVID high, obviously because there's been a lot of adverse impact to the business. So I don't think I'll be that interested in investing if it was above this. But it seems to have recovered quite well on the whole, with people being generally bullish. It's not quite been a smooth ride if we look at this in a little bit more detail, and it seems to be bouncing around a little bit, but on the whole, it's been an upward trajectory. I thought I would briefly mention insider trading as well. Over the last 12 months, there have been considerably more sells than there have buys. Over the last 3 months, the buy to sell ratio is looking a lot higher and a lot better, but it's something to consider when management are looking not so bullish on the company. Okay, so let's have a look at Coca-Cola compared to their competitors. So we've got a few on here. Pepsi is really the one to pay close attention to because, as I mentioned, Coca-Cola and Pepsi are very much in this duopoly structure. So looking at the valuations, I mean, Coca-Cola is looking a little bit more expensive than Pepsi, but then when you use free cash flow metrics, Coca-Cola is actually looking a bit cheaper, which is a quality sign. So I like that from Coca-Cola. Monster Beverage is looking a little bit more expensive. If you look at the kind of quality metrics, so we've got the margins, return on invested capital, and asset turnover, Coke does pretty well compared to Pepsi, particularly on EBIT margin. Asset turnover is not as good, although I often wonder, I think a lot of this is because Coca-Cola focuses so much on being a asset light and non-capital intensive business, so that could have something to do with it. And then looking at the forecasts, I mean, again, Monster Beverage is got the highest, so those high valuations might be justified. But it's a similar thing with Coca-Cola, so similar valuations compared to Pepsi, but it's beating the forecast in turnover growth, and then over 1 year as well, free cash flow growth over 3, and free cash flow growth over 1 year. So, I mean, look, these valuations for me, like I think they're very, very high for a company like Coca-Cola. 26 PE, 20 EV, EBITDA, 25 free cash flow. I mean, they are high, but compared to Pepsi, it looks slightly better than Pepsi in my opinion, but that doesn't necessarily mean they're a good investment. Let's delve into their valuations and try and work out a fair value of the shares. Okay, so here we have our free cash flow matrix. So you can see the free cash flow growth up top. These are the percentage returns the analysts are forecasting for free cash flow. I forecasted a couple of years after that at 5.5%. And basically, when you do a discounted cash flow like this at a WACC of 7.2, you get about $50 a share, and it's currently trading around that level. So it's looking like it's fair value based off this. When you kind of look at the matrix and you look at different growth rates, 2, 4, 6, or 8, these are the outcomes. So it's undervalued in the green, it's overvalued in the red. This box that I highlighted, this would be most likely where I think we would be. 6%, I think 6% is quite generous. I am obviously aware, as I mentioned earlier, that I think the analysts do tend to have positivity bias on this stock. So sometimes I think maybe it's better to go for 4%. I do think they're going to grow in the future. I don't think it's going to be negative, but anywhere in this box, I would kind of feel most comfortable. 7% discount rate, yeah, that's roughly what WACC gives us. 8% to give a little bit increased risk because of COVID. I don't think we need to discount a safe company like Coca Cola at 9 or 10%. So this box is currently where I'm comfortable with, which is suggesting that these shares are a little bit overvalued, 48, 53, 43, 39. It's not quite where I'd want the share price to be. So from a discounted cash flow perspective, that's what my numbers are giving me. Okay, so moving on to the EPS forecast and price to earnings multiples. So, okay, we can see here the earnings per share growth from the analysts, relatively generous. You got 10, 8%, 7%. When you average these out, you get about 7.5%. So that's kind of the levels that we're looking at, slightly higher than free cash flow growth. And the historic PE, with the exception of 1 year, it's been about 26 with very little variance. So these are the kind of numbers that we are looking here. If we look at the matrix, I really think a PE of 25 is quite generous. This is what it would give you. The earnings per share would have to grow at 10% a year in order for the shares to be undervalued, and that would only be by 1% margin. And also, they're not growing at 10% every year. Analysts only say it beats 10% for FY21, and then we see a bit slower growth thereafter. This is probably because we're getting quite a lot of rebound from the COVID pandemic. So they're thinking, 2021 is going to be a pretty good year as they recover from this slump that they saw in 2020. So yeah, I do think a PE of 25 is too generous. I'll be more inclined to go with a PE of 20, just because I think the market always overvalues Coca-Cola's brand, and as I said, it's just got this whole reputation with Warren Buffett being invested in it, and I think it just allows. Yeah, it allows valuations that are relatively high. So if you want to be conservative, a PE of 20 would be much better. And then looking at these growth rates, 6%, 8%, the shares are looking quite expensive. So yeah, what would that give you? Fair target of $37, fair target of 39. If you do think that the PE can be 25 and they can grow at 6%, then maybe 47, maybe 49. But none of these sales are really screaming undervaluation to me, unless you're forecasting very high growth rates with super high PEs. And I just don't think that's where we're at with Coca-Cola. You don't see 10% forecasted really here in the long run. And I think a PE of 30 or 35 would be pretty insane for Coca-Cola, considering they have struggled to grow. You have the headwinds from COVID, and also you've only seen them trade at a PE of 26 in the past. Okay, so if you haven't guessed already, I think shares in Coca-Cola are a little bit overvalued. Quality brand, sure. Quality business, most definitely. Recession-proof, probably. However, I do think people do give Coca-Cola this massive brand premium just because it's such a well-known company, it's been around for so long, and because Warren Buffett owns it. And I don't think a multiple of 26 times earnings is justified for the company when the turnover has been shrinking over the past decade and operating profits and net profits have remained relatively flat. If Coca-Cola do manage to weather the storm over the next few years, they get out of the COVID headwinds that they're in successfully and they grow their earnings per share, I would certainly consider picking shares in the company up, but it has to be trading at a lot less for me, more like a 15 to 20 multiple. Will I ever get that opportunity? That's for the market to decide. I really hope you guys enjoyed my analysis on Coca-Cola, and I wish you all the best with your investing in the future.